I now recognize the gentleman from Georgia, Mr. Woodall.
Thank you, Mr. Chairman. Thank you for holding the hearing. You have always been one of my top two choices to chair this committee, and I'm glad to see you in that chair today. Mr. Hall, you were talking about inexplicably flat wage growth. I'm not an economist. I'm a lawyer. Help me to understand what we call wage growth. I think about when we went into the Great Recession, and folks who would have been working in a top financial institution in my community were now working the customer service desk at Macy's. They were making the top wage there at the Macy's customer service desk, but they were making substantially less than they were making in the financial services industry. Does that count as a wage drop? Is that reflected in wage growth statistics when you move from one job type to another?
It does. It depends a little bit on which measure you're talking about. Something simple like just wages, it doesn't capture that very well. One of the things that we look at is something called the Employment Cost Index, which sort of holds the composition of the labor force constant and look at how wages drop. So different wage measures tell you different things. Some of them include full compensation, some don't include all the compensation. So there are a lot of measures, and they sort of can tell you sometimes a little bit different pictures of things.
Because when we look at the who's quitting their job index, more Americans leaving the job they had to pursue new opportunities, it just stands to reason to me that if more Americans are taking advantage of a superior opportunity, more Americans are acting in their own economic self-interest, we should see a positive bump in those remuneration measurements somewhere, but we're not, as you pointed out, in wage growth. Help me to understand why.
Sure. Well, we're not really sure because we didn't expect this, and I think the profession didn't expect wages to take quite so long to get going, but they are starting to get going now. We have seen some growth. The ECI in particular, I mentioned, was one that we look at, and we think that it's going to continue going forward because the labor market's still pretty tight. We still think the unemployment rate, even though it's very low, we still think it can go down from here. So we do think it's going to increase going forward.
Thinking about Mr. Scott's question about long-term economic growth, as long as I've been on this committee, as long as you've been in your position, you've come and made that same testimony. There are things we can do early that will benefit us early, but they'll cost us later. Or there are things we can do that will cost us early that will benefit us later. We're always in that trade-off. I look at the long-term growth numbers, your projections this year from the 2017 projections 2 years ago, and we're about 1/10 of a percentage point off in long-term growth from your projections 2 years ago in the out years. But we're $1 trillion higher in GDP 10 years out from there. We've had growth in these near-term years 50% higher than what you would have anticipated 2 years ago. What's the long-term measure that we look at to say, yes, there is a trade-off between what we do early and what we do late, but it's worth it? What do the economists look at to say it's worth it?
Well, one of the ways to think about it is we have really kind of two distinct models that we use to forecast growth. One is a demand-side model. It sort of looks in detail about where we are now and where we're going. That has all the detail about, consumer behavior and investment and that sort of thing. But we also have a second model, which is a long-term model, which is a supply-side model. And it generates something we call potential GDP, potential growth, which is that supply side. And that's the one that tells you where we're going, we think, in the long run. So we then focus on things like labor force growth and productivity and capital investment and that sort of thing. And those are the things that are going to be the big determinants of long-run growth and long-run prosperity.
And you use the term long run to describe what time window?
Yeah, and by long run I really kind of mean once the economy reaches its potential. By potential I mean the supply side constraint on where we can go. We only have so many workers. We only have so much capital. That's sort of what I mean by the long run, when that constraint becomes binding.
So as I look at the projections you've made this year versus those you made prior to the tax cuts, I see a larger GDP than you had expected in the 10-year window, suggesting cumulative growth greater than you had expected in the 10-year window. I recognize the concerns that folks have about we're trading away prosperity tomorrow for prosperity today, but it seems like we have increased prosperity relative to your expectations just 2 years ago over the entire 10-year window.
Well, when we looked at the effect of the tax cut, we expected the tax cut raised GDP last year by about 0.3 of a percentage point. So it did have an impact on growth there. We think the impact continues going forward, so that on average over 10 years, we think the GDP level will be 0.7 of a percentage point higher. So we do think we have a bigger economy this next 10 years because of the tax cut.
Okay, gentleman's time has expired.